Hey guys, I'm gonna try and make this video as quick as possible for you guys. Um, Once again, it's currently almost 1 in the morning. I live in the Pacific Standard Time, so I need to get up in about 6 hours or 5 hours before market open. So, um, I'm gonna try and make this video as quick as possible. So yeah, this video is gonna be on options. Sorry guys that I took forever. I know I said I was gonna make the video on Monday, so I apologize for taking all the way until basically Wednesday to make this video. I've just been trying to put a script together for you guys just to make it as simple as possible. And that's exactly what I did. And if you stick around for towards the end of the video, I'm also gonna explain the most simplest way to look at or to how to understand um, options in the most basic, most simple way. Um, but before we get to that, I'm going to explain to you everything that you see in this chart right here, or this options chain, whatever you want to call it. So anyways, let's get to it. So I don't have a chart up right now in case you haven't noticed, just because we don't need it. We're just solely going to be looking at our price right here and our options chain right here. So, I also have it set to calls only instead of both, because if you were to look at this, I know you guys would just look at this and be like, what the hell am I looking at? So, let's make it simple for you guys. Um, so I believe usually when you have your first options chain open without adjusting it, you're going to have a whole bunch of numbers everywhere. If you just look at mine, this is really all you need. You have your strike, obviously. You have your ask, your mid. Oh, sorry. You have your strike, your bid, your ask, your mid price. This is preference. This doesn't matter. That's not a Greek, whatever, but I usually have it just to get the mid price between the bid and the ask. So remember, guys, the mid is between the bid and the ask. So 445 and 465. What's the mid price of it? 455. And I'll explain all that later throughout the video. We have our delta, theta, gamma, vega, and our IV. That's really all you need. You don't need anything else. For example, let's see. I don't really want to mess with it. I guess no example. My bad, guys. Anyways, this is really all you need. And to be honest, you really don't need any of this stuff. Realistically, all you need is delta and theta. Um, and obviously your bid and ask, but I'm just talking about the Greeks here. So delta, theta, that's really all you need. You really don't need anything else. You just need to understand what everything else is. But yeah, so anyways, for those of you guys that don't know anything about options, let's start off on the left side and we'll work our way to the right side. So we have our strike price. What people say is this is what you think the stock will go to, and this is what you think the stock is, blah, 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 blah. I've watched countless videos when I first started learning how to trade options, and they all told me the same thing. The strike is whatever you think the price will go to or whatever it's at. They are right, but there's another easier way to explain it. At least for me, I'm a little stupid, so just hearing that, it's like, okay, I don't understand. So basically, the strike prices, they are right, but in another way is to look at it as you have our in the money up here, you have our on the money, and then our out of the money. Um, so the way Apple's contracts are is that they're set $2.50 away from each other. In case you haven't noticed, like you got 260 right here and 262.5. That's just how Apple is. There's other contracts that have it $3 spread out, or a dollar or 50 cents. It just depends on the stock. But for this one, we're gonna do Apple, and then we'll go over another one. Um, another stock, just so you guys can look at it and get a feel for that one as well. So yeah, here's Apple. Here is our on the money price, our 265, or 262.5. So what contract should I buy? So, first of all, actually, this one might be a little too confusing for you guys. Let me just go to Netflix. So Netflix, 77 is our stock price, and our strike price is right here. 77 is our on the money, 78 is out of the money. Anything below 77 is in the money. So, what is in the money? In the money means, obviously, as you can tell, as what price was already at. So, obviously, since our stock price is currently at $77, we were at 72 and we obviously pushed above 72. Now we're at 77. So, yeah. And then you have our out of the monies from above 77, meaning, okay, I believe um it's going to hit 78. So let me go ahead and pick up that contract. And it's not even about what you think or what it is. So sometimes a lot of people, and I do the same thing as well. Sometimes it just really depends on the stock. But I used to do this as well. Usually I used to just be like, okay, I'm gonna just pick up a contract just because it's cheaper. So let me go ahead and pick up a 80 contract. Um, but another thing you need to take in consideration is your expiration date. So let's just do a 27. What the hell? What is going on here? Why does it look like this? Okay. Does it not allow us to? Okay, whatever. We're just gonna look at this. So we have our contracts right here, are with our expiration dates right here. This will tell us how many days we have left. So if we take a look at February 20th, this expires in 2 days from now. So right there. Um, so anyways, we have our contracts right here, blah blah blah. Okay, now let's get into it. So each contract you're buying 100 shares of that specific contract. So, what do I mean by that is you're not buying 100 contracts of $77. You're buying the contracts right here from the bid and the ask. So, um, the buyers, so the asking price is what sellers are asking for, and the bid price is what buyers are willing to pay. In easier terms, the buyers buy the asking price and the sellers buy the bid. So if you're going for puts, you're you're going for the bid, and if you're buying calls, you're going for the ask. Obviously, just because you see these numbers doesn't mean you have to buy that. Obviously, if I want to go for calls and I go with the ask, um, I can obviously change it. I don't have to get filled at 125. Um, but that's usually the fastest way to get filled just because they're already asking for that price. You can obviously ask for the mid price, which is 124. So in between 122 and 125. Okay, no, that's not 124. It's 123. But it's probably down to the decimal points. To where actually no, I'm stupid. That is the mid. um, I mean, I guess there's really no mid price. I guess it just goes down to the decimals. But if you look here, the 76 and the 78, the mid price is 77. Sorry guys, I'm just really bad with math. I'm really stupid with math. Anyways, so yeah. So there's that. You don't have to buy, but you can buy in between. You can buy out of it, but it's usually in between or on the asking or on the bid if you're selling. Anyways, so remember guys, you're buying this for 100 contracts. So let's just say I want to go for calls. So I want one contract. So my total will be 125. If I want to buy two contracts, it's going to be 250, and then 375, so on, so on, so on. So whatever it is, you just want to multiply it by 100. So same thing for this, 78, it's going to be $78. So whatever it is that you're buying, multiply it by 100, and that'll be your price. Okay. So let's move on. Let's go to the delta. What is delta? Delta is how much money you make per dollar move. So, example, we have our delta at 0.51. So, remember, we're multiplying it by 100. So, this is 50 cents. So, if you multiply that by 100, that will be $50. So yeah, times 0.50, that'll be $50 right there, $51. That's how much you will make per dollar move. So the delta, I don't know if you guys have a pen and paper, whatever you guys are taking notes on, pen and paper, notepad, iPad, whatever, sketchbook, I don't care. This is very confusing stuff, so I really recommend you get something out to write this down. So the delta is how much you make per dollar move. So if Netflix is currently at $77. If it moves up to 78, your delta you will make $51 off that dollar move, just strictly off delta. Um so yeah, there's that. And then also, if it doesn't go your way, so if Netflix moves down to $76, then you will be negative $51. And then so on and so on, you know. So yeah, but that's just solely delta, not including the gamma and the IV, the vega, or the theta. Is just solely delta. The theta, the theta is the easiest one to understand. The theta is how much you lose per day on your contract. So we have 2 days left on our contract. So let's just say Netflix, for whatever reason, doesn't move at all, and we end up closing at 77, and then we have 1 day left. So we will lose $24. Remember, guys, this is multiplied by 100. So that's where I'm getting the $24. So you will lose $24 on your contract. Once again, not including Vega, IV, your gamma, blah, 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 all that stuff. This is just solely theta. So the theta is how much you will lose that day. So this is basically time decay, basically. That's literally what it is. Gamma. Gamma is how fast the delta changes when the stock moves per dollar. So, for example, if our delta is at 0.5 and our gamma is at 0.3, so like I said, guys, write this down. So if our delta is 0.50 and our gamma is 0.03, um, so the first dollar you make will be $50, your delta. So after you make that first dollar, let's just say, okay, so let's say you make the first $50 on Netflix at that 78. So let's just say Netflix goes to 79. Once it goes to 79, that's when your gamma kicks in, and instead of getting that zero point 0.5 delta, the gamma adds on to your delta, which makes it 0.53. So when you get that, that will make your delta make you make $53 instead of the original 50. And after that, your total is $53, or your total is $103 instead of $50 without the gamma. So remember, guys, and it's the same thing vice versa, by the way. So if it were to go out of your favor, you lose $50, and then once you get to that second dollar drop, it'll move your contract to 47, and you will lose $47. So yeah. So remember, guys, it goes by dollars. It doesn't matter the contract, the strike price. Like I said, Apple's is $2.50. It doesn't matter by that. It goes strictly off a dollar movement. Um, so yeah. Let's see. What other examples do I have for you? I have a bunch of stuff written down here on my notes. Um, let's see. Okay, now let's move on to Vega. Vega, where do I have that? Okay. Vega is basically, it moves with the IV. So if our Vega is at 0.10 and our IV goes up 1%, your option will go up $10 because remember guys, you're multiplying it by 100. Let me go on Apple because I think I wrote down these notes for Apple. Uh, Let me see. I had the February 27th. Okay, yeah. Here's a more detailed description. Which one did I use? Sorry, guys. I'm getting like super unorganized here. I just have notes all over the place, and I'm just forgetting it. Forget where I'm writing everything out. But yeah. So basically, let's use the example for Apple. So if the Vega is 0.17 and our IV is 0.28, our if the IV moves up to 29%, um, our Vega will add on to our contract, so it will be plus $17. Remember, guys, adding we're multiplying by 100 for the contract. So um, if we move up 1% from the IV, we make $17. If we move down to 27%, then we lose $17. Um, so yeah, that's basically that. And the IV can get a little tricky. The IV isn't the same. There's no such thing as this IV is the best IV for every single stock because every single stock is different. So the volatility of it is different. So the IV basically measures the volatility and just how crazy it is. So when there's something like earnings, the day after you'll usually see percentages of over 60%. Um, so yeah, it's very crazy. The easiest way to really understand this is you don't want to buy a contract when the IV is over 30%. Obviously, don't let this affect you from trading. It also measures out like the news as well. Like I said, usually you'll see IVs skyrocket once earnings hit. After earnings at least. So usually you never want to buy a call contract after earnings if it went good. Just because you'll get IV crushed, basically. So remember, like how I said, if you were to get in, let's just say this is at 60% from earnings. This is inaccurate because our Vega is most likely not going to be $17 when our IV is at 60%. But just for the sake of the video, just as an example, let's just say our Apple has earnings, it shoots up $15, and IV hits 60%, and our Vega is 17. So remember, guys, like how I said, every 1% that it moves, you will lose $17. Another easy way to put it is you never want to buy an option when the IV is high. You always want to get it when it's low. So usually for Apple, around 20%, 28% is perfectly fine. Anything above is too much in my opinion. Let's take a look at Netflix, FLX, 42. This I would say is a little too high. I'm not too sure what it had. Like I said, each stock is different. I don't think it had earnings or whatever, but like I said, each one is different. Oh wait, sorry. IV is high because there is 2 days left in our contract. So the IVs get higher once ODTE is near. So let's move out to the 27th. You see it gets lower. We're at 41% from 43. Let's go out to 23 days later, 41%. So it kind of seems like 40% is usually the normal price for it. Also, another thing to consider is that this just had a stock split, a 10-1, I believe. And I believe this happened 2 months ago, 3 months ago, maybe less. I'm not too sure. But we're over explaining stuff. We're over explaining. Let's keep it simple. I don't want to overload you guys with information. Um, so yeah. Anyways, let me just take a look at my notes real quick. Um, just to recuperate myself. Like I said, guys, I'm very tired right now. It's 1 in the morning. Um, what else can I do? What else can I explain? Okay, let's see. Let's go over buying the bid and the asking price. Usually I always like to get filled. I like to get filled right away. To be honest, I never like to wait because there's times where the move will happen to me if I want to get in the mid price. Sometimes I won't get filled, just because these aren't gonna stay the same. So whatever you're seeing right now is not gonna stay the same. This will jump up to $4.75 in like a second or move down. It's just stuck like this because it's aftermarket. Obviously, no trades right now. So yeah, so it's just gonna be stuck like that. So these contracts move, so I always just get filled at the asking or the bid price. Um, Another thing that you really want to look forward to is the spread. What is the spread? The spread is the bid and the ask. So there is a what is this? A $15 spread. Or let's look at this one right here. It's too easy. It's a lot easier for me. Like I said, guys, I'm really horrible with math. And if I'm horrible with math and I can learn how to do options, then so can you, because I doubt you're worse than me at math. I am horrible. I'm an idiot when it comes to math. Anyways, so we have a $6 difference between the bid and the ask. So if I were to get a fill at 113, I would automatically be negative $3 because we have some left over from the bid. And if we were to get our fill from 455, in between this, that is a $10 difference. So you'll be negative $10. The only time you'll be positive is if you can get the bid price, but you won't, you probably won't get that price. Um, so yeah. Another thing too, what else was that? What else was I gonna say? I'm like losing my mind right now. I'm very sorry, guys. That's pretty much it. There's not much to it. Another thing too, the overview of this is don't let this influence you on buying your contracts. None of this really matters unless it's ODTE. What is ODTE? It means the day that your contract expires. You don't want to hold it until your contract expires. Just because you will get fucked badly. Um, there's ODTE is a whole new thing. I'm not trying to scare you guys into not buying ODTE. You can make a lot of money off ODTE, but you can also lose a lot of money in ODTE. Buying ODTEs when the contract ends, the day the contract ends, is very tough because if Apple is stuck at 263 and you buy a 265 call, your theta is $80. You're going to lose $80 and your delta is only 36. So you won't make a lot of money. You'll have to get real deep in the money in order for in order for it to be worth it. This is why I say ODTE I really don't recommend, especially for you newer traders, just because it's really tough. Um, you have to get a perfect entry and it has to go your way perfectly. So yeah. Um, anyways, um, what else was I saying? I got off track. I already forgot what the hell I was saying. Um, Another thing. Oh yeah, like I said, don't let all these Greeks influence your trades. Obviously, if you're taking day trades, theta doesn't matter to you. Um, Delta it matters. Just look at it. Even if it's low, I mean, it doesn't, it shouldn't matter to you. It really doesn't matter. Even if it's low. But the only time it'll be low is when it's really out of the money. And then, but yeah, the contracts I usually buy, like I said, it's usually on the money, 265. I never get in the money just because the spreads are very wide and it really has to go your way in order for you to really make money. Um, Another thing, I never buy way out of the money. Um, or weeklies. So weeklies is the week it expires. So let's say what is whoops, sorry guys. So if I'm buying a weekly contract on, let's say, Monday, the February 16th, so 2 days ago, and my contract ends on February 20, I don't want to hold it till then. But like I said, guys, none of this stuff matters if you're just doing a day trade. The only thing that matters is the bid and the ask, the spread, because that's the only thing that's going to put you in the negative as soon as you're in a trade. Um, what's a good spread? I would say, oh man, it's a tough one just because they're all different. Like how I said, there's a $15 spread from this, and right here there's a $6 spread. If we look at, I believe, Home Depot, they have a pretty crazy spread. Like, look right here, there is a $70 difference. You're gonna be negative $70 if you buy, straight the asking price. So it's very tough. You want to try and get a midfill. It obviously just depends on what you're trading. Um, but yeah, it can be a little tough. But like I said, don't let all these Greeks influence your trades. It doesn't matter if you're day trading. Me personally, I never pay too much attention to these Greeks, because at the end of the day, as long as there's no crazy earnings or crazy news that happens with these stocks, it won't matter. Um, just because as long as it goes your way, then everything's gonna be perfectly fine as long as you get a low spread, a low fill in the spread. So like I said, if you get a $15 difference, that's a pretty wide gap. Just as long as as if it goes your way, you'll be fine. If not, you're gonna lose quite a bit of money on top of that $15. So like I said, if the stock moves $1 out of your favor, you're gonna lose $48. And then on top of that, if you get in at with the $15 difference from the spread, you're gonna be negative plus 15 on top of your $48 delta, and then obviously your gamma on the next dollar. So now here is the most simple way that I've never seen people talk about when they talk about options. This is the most simplest way to understand without including the Greeks because it already includes it for you. Another way to look at this is to just look at the bid and ask. That's all it takes. So, if this stuff is too confusing to you, just look at the bid and ask. What did you buy it for? Let's say I bought the contract at a midfill for $4.55. Let's just say Apple goes in our favor and our contract goes to $6.20. So let's do the math. So let's say our 265 call goes in the money. So our $4.65 contract that we bought, or sorry, our $4.55 contract that we bought, which costed us $455, has now moved to $6.20. So let's do the math. 6.20 subtract $4.55, our price that we got in at the contract for, we now have a difference of $1.65. So I have now made 165 cents or $165. Remember, guys, we're multiplying this by 100, so you get the contract. So you subtract the $6.20 to the $4.55, and we get $1.65. Times that by 100, and you get $165. That's how much you've made in your contract. And that already includes the Greeks, so you don't have to pay attention to all this. If this is too confusing to understand, just go by the contract. Go by what you bought your contract for, to what the asking price is, or the asking price, yeah. And that will be what you're, or sorry, I think I'm getting confused here. Sorry, the bidding price. That's the one. Sorry, like I said, guys, I'm being stupid right now. I know I might seem a little confusing to you. It's 1 in the morning. My notes are all over the place. So yeah, so let's do this again. Let's do the math again. $4.55. And let's say, or sorry guys, again. $5.75. So this one, like I always said, our bid price subtracted by $4.55, our fill. So we get a total of $1.20. Multiply that by 100, and we now get $120. So that's how much we made. Obviously, it works the opposite way around. Um, I'm too stupid to do the math on that, but it's the same thing vice versa. So yeah, that's basically it. That's the most basic way to understand it without knowing how the Greeks work. Um, I really hope I really um taught you guys how to do these options. Like I said, guys, I'm very new to teaching, so I do get a little stuttered in my words. I do get a little tripped up on my notes, especially with options. Options is a very difficult thing to learn. One thing, when I was first starting out on how to trade, I was trying to learn options at first, and then there was delta, all this Greek stuff. I didn't have any idea what any of that stuff was. So after that first video, I was like, screw it, I'm doing futures. All I got to do is click buy or sell, and my positions right there. It shows me blah blah blah. And yeah, so I understand you guys, that options is very difficult. It took me a little while to really get the hang of, but at the end of the day, this is the way I put it to myself to really understand, and I try and give you guys the best way possible to really understand this. So just a quick overview, guys. Like I said, delta is how much you make or lose. So 56 cents. Remember, multiply by 100, so you lose $56. Theta is how much you lose at the end of the day. Um, so yeah, and then the gamma is how much that adds on to your contract. Or sorry, is how much that adds on to your delta, and then your vega is how much you make per 1% of the IV. And with the IV, guys, remember, you don't want to buy IV when it's super high. You always want to get in the IV when it's super low. And then, so that's why people usually buy contracts before earnings and then sell it after earnings, because if it goes your way, the IV is going to be super high. And if you want to hold it, whatever, you're going to get screwed over. so, so yeah, just because the IV will go down very rapidly as as the stock tries to calm down. So yeah, there's that overview, guys. Like I said, if there's something that you're stuck on, um, you can always comment on the video, at me in the chat, do whatever. I know, I'm sure some of you guys still might be confused. It took me a lot of videos and a lot of searching up on my own part to really understand it. But like I said, if you guys want me to hop on a voice call with you guys and go over the contracts personally, I'm willing to do that as well. Um, but yeah, there's that. That's basically it. So just like how I said, at me in the chat if you guys have any more questions, or you guys can comment in the video. I can make another video, whatever you guys like. Like I said, guys, I'm always here to help. So yeah, that's basically it. That's all you need. You don't need anything else. Like I said, you really don't need to pay attention to all these Greeks. Yes, it's good to pay attention, um, but this shouldn't influence you on whether you should buy it or not. Just because it really doesn't matter unless you're buying ODTE or there's big news or earnings, something like that. So yeah, that's basically it. Any questions? Like I said, just at me in the chat, comment on the video. So yeah, that's basically it. So yeah, see you guys in the next video.